As part of CNBC TV18's 20th anniversary celebrations, we've been bringing you a unique insight into the minds of fund managers. And joining me today is Neelesh Surana, CIO at Mirae Asset Global Investments. Neelesh joined Mirae Asset in 2008 and spearheads the equity investment function. So just a brief about Mirae itself, their AUM in equities stands at about 35,000 crores and it's amongst the fastest growing AMCs in India. Neelesh co-manages the Mirae Asset Large Cap Fund, the Mirae Asset Emerging Blue Chip, as well as the Mirae Asset Tax Saver Fund. Neelesh, thanks so much for joining in. And, first, before we get talking about your fund, I want to talk about the market itself because, we're in the throes of an economic slowdown. How is this going to affect the market overall? What do you make of where, the economic reality of India today stands?
Thanks, Sumaira, for inviting me for this show. So indeed, the economy is slowing down. Many sectors are passing through a slowdown. I mean, in terms of outlook, where we see things panning out can be, say, bifurcated into two parts: short to medium term and the longer term. Let's say, short to medium term, let's say next 1 year, I think things should improve from here. I mean, the glide path should be upward facing for many reasons. One is the base will be favorable. I mean, that's optical, but the problems accelerated sometime last year in November of 2018, post-IL&FS and other NBFC crisis and liquidity issues. So with favorable base would help some of the broader numbers. Second and more important is the fact that this time the interest rate is yet to be transmitted in the system. While Reserve Bank has cut the rates by about 135 basis points, but it is not passed on. I mean, be it AA corporates, be it various products, it's more work in progress in terms of the interest rate reduction. And interest rate is a significant lever. It helps demand of rate sensitive businesses. It improves the cash conversion for the same EBITDA, and also P multiple has a correlation with the interest rate. So that's the second point. And third, why things should improve is also the fact that over the last few months we have seen that government is taking a lot of actions in some of the weaker spots, and there are directed actions, and there have been large reforms in terms of generous tax cuts, etc. And just to look at more a longer term issue, 5-year plus sort of outlook, I think the pillars to grow the Indian economy, which is basically demographics and the benefits from that, and the potential in infrastructure, these two pillars are fairly intact. And in addition to that, we have seen over the last 3-4 years many reforms. I mean, if I have to call out 5 reforms, important reforms: the formation of MPC, then we have GST, then we have RERA, then we have the large tax cuts and IBC, all put together is laying a good foundation for growth to mean revert. Just concluding on markets, I think markets are holding on well, and I think generally markets are leading indicator. So to that extent, they are sensing the recovery in the economy and the earnings growth.
Okay, and then on to your funds, because there's one investor, Paresh Sukthankar, who wrote to me on Twitter, and perhaps he's asked the question that everybody wants to know, which is, what has made Mirae achieve superior returns across its gamut of funds?
Well, thanks for that generous compliment. I think the performance is end result of stock selection and portfolio construction. So as far as stock selection is concerned, I think a lot of contribution has come from what our research team has delivered in terms of identifying the right set of business and not overpaying for that. In terms of the second aspect, which is the portfolio construction, the approach we have is to have a risk-adjusted sort of approach in terms of constructing the portfolio. I mean, no sector, stock, style or theme should have a disproportionate weightages. I mean, the psychographics or the character of the portfolio should have some semblance to vis-a-vis the benchmark. So I think combination of both the factors have yielded decent returns. I mean, buying right set of business, not overpaying for it. As I think it's a combination. If you do attribution analysis, it's more stock selection, and it's multiple factors which has yielded satisfactory results in the past.
Okay, so what is the stock selection criteria then? Because I think you were one of the early entrants into, say a stock like Page, etc. So how do you really select these stocks?
No, so I would not like to comment on the stock which you mentioned, but generally what's the template of stock selection? So there are three buckets to analyze and filters are related to that. What is the selection of the business, the evaluation of the management, and what price or the valuation we are paying for that business. So in case of, let me just elaborate in each of these very briefly. So business selection, basically idea is to buy growth businesses, and growth, one can be defined growth as, let's say, any business which can grow double the real GDP growth, let's say double digit growth, mid-teens, high teens. That is a filter you have to put first, because India is a growing economy. You have to buy growth. Equity is all about growth. And the second filter is that the character of growth should be value accretive. So the return on capital employed, we have an internal filter that pre-tax return on capital employed should be north of 15%. So that's on the business part. And second analysis is more related to the selection of the management, which is much more meaningful these days. We have seen what has happened over the last couple of years. So here the idea is to have the basic hygienes of the management in terms of capital allocation, corporate governance, and also softer aspects in terms of the thought leadership. Because if I have to say one single thread over the longer term, which is between wealth creators and not the companies which have not created wealth, I think management plays a significant role. I mean, any sector you look at it, there are winners and losers. You look at banking, you look at many of the businesses, even in consumer names and all, there is difference between stock returns, and one of the reasons of that is how the management is treating the minority shareholders, what is the capital allocation, and do they have the right thought leadership to grow the business. The last aspect is in terms of stock selection is the valuation. So here we need to have a margin of safety. I mean, you have to buy when value is more than the price. So I think these are the few filters which is a template to select stocks here.
Yeah, and unfortunately, it's valuation which gets most of the coverage, and some of the other aspects which are much more important sometimes get left behind. But Neelesh, so much about picking a stock. Yes. How do you decide when is the time to sell a stock or exit your position?
Sure. So ideally we are long-term investors. You like to, if you pick a good business, then you like to hold it for a very long period of time. But selling gets triggered under certain conditions. One is, as I've mentioned, that you have to buy when price assessment of value is more than price. When the reverse is true, when the price becomes significantly more than the value, and we are seeing certain pockets in the current context of the market. So that obviously would mean that you either go underweight or reduce or exit the stock. The second situation could be that businesses are dynamic. Assumptions can change both our internal assumption as well as externally. We have seen what happened in healthcare over the last 3-4 years. So that situation, we have to constantly review the stock or the position and take a call on that. And the third situation is generally because we are most of the time fully invested. Many a times a particular stock within a sector falls and you want to, let's say, sell X to buy Y. So I think these are the three sort of situations which triggers a sell call, of which the first is the most important.
Okay, fair enough. Let's go back to this point on valuation. And what's your take now of the polarization that we're seeing in the market and, the valuation of quality companies?
No, very relevant question in current sort of context. I think literally post-global crisis we have seen, and particularly last few years, I think two buckets in the market. So there are a set of few businesses, few companies which have predictability in earnings. They have been doing well even in challenging times, and to that extent in the current environment I think many investors, instead of taking management or the business risk, have been, the valuation of that bucket has been inching up. Some of it could be frothy, some of it could be justified, but of course that is one end of the spectrum. At the other end, what has happened is there are a certain set of businesses where either it is a leveraged business or well-managed group also, or utilities or power, or maybe government-owned entities and metals, and a lot other business of healthcare, where the earnings visibility is a bit patchy in the short to medium term, and that has got beaten down. So this polarization has become quite significant at this point in time. I think it gives both opportunities, particularly in the second bucket. The margin of safety is very high, so it's giving a lot of opportunities.
Okay, when I put it out on Twitter that you'd be coming on the show, I got a lot of queries that came in on the fund positioning, because there have been some new launches in terms of fresh funds that have come out. Can you explain now the overall positioning?
Sure. So, I think the positioning today, as we speak, we have a portfolio of 5 diversified fund. We have 2 hybrid products and 2 sectoral fund. And the couple of changes which happened and couple of launches which happened should be seen in light of multiple factors. One, of course, was SEBI reclassification. Yeah. Second was in one of our product, it was there was a bit of ambiguity. Our large cap fund was somewhere classified, some agencies were reading as a multi cap, somewhere it was large cap. So there was a need to sharpen the sort of positioning and the communication on that. And third was there were gaps in the portfolio which we had to sort of fill, and also the last aspect was scalability of the overall sort of portfolio basket. All considered, I think, now it is fairly well positioned. 5 funds which we have, as I said, the 11-year-old fund is a large cap fund. We have emerging blue chip, which is large and mid cap, and very beautiful category. It's actually a well defined multi cap category, sort of, if you look at benchmark, 50% large cap, 50% mid cap. We have a ALSS product, and then we had gaps of not having a multi cap product, so we launched a focus fund, which is managed by my colleague Gaurav, who is also lead manager for large cap fund. And we also there was no mid cap funds. We launched in addition to the focus fund this year a mid cap product, which is managed by Ankit, who is also co-managing the emerging blue chip fund. So I think now while 2 changes were there, they were not significant change in terms of the portfolio construct, particularly the large cap fund. But now the portfolio basket is fairly well diversified for investors to pick and choose based on their risk profile.
Yeah, the compulsions of getting to be a full service fund house, I can totally take your point. But also a lot of questions, Neelesh, between what should be the ideal allocation now between large and mid caps?
So we believe that for the longer term, the allocation should be more skewed towards large cap. Say about 3/4 or 2/3 of one's portfolio should be in multi cap or a large cap oriented sort of fund. The reason is multifold, because large caps in India, given that it's a growing economy, they're not devoid of growth. Plus, many of the large caps have better sort of margin profile, better return ratios, and also the fact that the drawdown is less in large caps. So large chunk of about say 70% should be more towards large caps. Mid caps are looking interesting. They have corrected big time over the last 18 months, and they should also be a part of the portfolio, but this should not be in the expense of large caps. So it's not, they should be about 1/4 or 30% of the portfolio.
Okay, with that, Neelesh, we'll take a very quick break. We'll come right back, and do stay tuned into Fund Anatomy, because we have a lot more questions for Neelesh, and there's a very interesting rapid fire round as well that's coming up. So stay tuned. Welcome back. You're watching Fund Anatomy, and with me today I have Neelesh Surana, the Equity CIO at Mirae Asset. Neelesh, we've spoken so much about your funds, but I have a question that actually I want to ask, and which is that, do thematic funds have a place in an investor's portfolio, and why? Because so many of the themes which are in flavor anyway find prominence in, like say the fund's large cap fund or a multi-cap fund. Those themes anyways play out over there.
Sure. No, your observation is right. What I would say is that the core portion of the portfolio should not be the thematic. It's more for sophisticated investors, and also it depends on which theme. Only when the longevity of the theme is for few decades, it's better to invest in thematic fund.
Yeah.
That's why in our case we have a consumer fund and a healthcare fund, because we believe these are the themes which will last for few decades. So otherwise what happens is, generally if you buy a thematic fund looking at the past immediate returns of last 3-5 years, that could be an error. So technically, whatever 15-20% exposure to some of the long theme can be appropriate here.
Yeah, I remember, some investors talking about how they had got these infra thematic funds. So they had 20% allocation to that, and then the large cap fund had it, and the multi-cap. So overall, they had some 68% allocation to infra. But anyway, speaking of funds, we have a query that has come in from Pankaj Jain, who wants to know what should be the ideal number of funds in an investor's portfolio?
No, so there is not a simple answer because there are experts who look at individual risk assessment. But in general, I would say that not less than 4, 5 and not more than 8, 10. And so anywhere between 5 to 10 should be the number of funds in one portfolio. And the important thing is, just like we build stocks in our portfolio, the character of those funds and they should be different, slightly different. Otherwise, the risk return metrics should be different. So basic thing like not giving too much to one manager, one AMC, those sort of risk measures should be put in. But anywhere between 5, 7, at max 10 funds, I think is more than sufficient.
Yeah, and basically complementing each other's styles. Okay, you know, across your funds, one common theme that I found was financials. Is that one of the themes that you're bullish on or you're positive on?
No, yeah. I mean, many factors for this. One is obviously we are positive on financials, particularly private financials, because they would benefit not only from the growth in the economy. There is a clear trend of value migration or market share shift from state-owned lending to private financiers, both because of their superior asset franchise and liability franchise. So that clearly is one reason. Second is also, at this point in time, financials are doing heavy lifting for the earnings growth. So next 2 years, the large part of earnings growth is coming from financials. And lastly, I would say, while financials do look heavy in most of the portfolios, is also the fact that most of the benchmarks, they have almost 30-35% in financials. So we are benchmarked we look at the benchmarks to that extent. So multiple reasons why financials look quite heavy, and a lot of names in top 10.
Okay, it's time now for rapid fire. So I'm going to give you barely any time to answer my questions. Between growth or value investing, what would you choose?
No, I would say growth should be subset of value. So it's a combination, yeah.
Fair enough. You said that you're almost always fully invested. You don't like to keep a lot of cash allocation. So what is the ideal?
No, we are, hardly 3 to 5% cash. Otherwise, most of the time we are fully invested, yeah.
Okay. Is investing an art or science?
So institutional money management and the kind of products which we have is more of a science, because there is team, there are processes, and it's all about the process part of it to adhere to the mandate. So it's individual stock picking or could be an art of it. So I would say it's more of a science here.
Okay. Name one improvement that you have made to your investment process, and why wasn't it incorporated earlier?
So our head of research, Harshad, he started this year this concept called sector neutral portfolio, wherein individual analysts, they run a dummy portfolio and it's properly audited. So that is a new process which we have started. Why it was not, or any process is not there, I think the process improvement is more of a journey. We can't say that we have reached the best. So at various point in time, you keep on evaluating, including fine-tuning certain processes or dropping some of the processes which are not meaningful.
Okay, as long as the journey continues. What's the worst possible macro environment for your strategy?
For the country, for markets, I think the macro, one of the important variable which can impact negatively is clearly oil prices. Any significant and sharp sustained increase in oil prices to $80, $100 put a lot of macros under, make it very delicate, be it trade balance, inflation, interest rates. So oil clearly is a risk.
Okay, which would you sacrifice first, performance or philosophy?
Performance.
Okay, in order, can you arrange this in order of importance? Valuation, business or management?
It's business, management and valuation.
Okay, do you invest in your own funds?
Yes.
Okay, what are your notable mistakes and what did you learn from them?
So as a team, we constantly sort of review our mistakes, and in our profession there are two types of stock selection. There are two types of errors. Errors of commission and errors of omission. Those good opportunities missed is also an error. So it's a constant process to evaluate which we have missed in the past, and sometimes what should have been done in terms of due diligence if there are errors of commission.
Okay, and finally, Neelesh, given the current state of the market, what would be your advice to investors?
No, I would say that while macros are important, I mean, it's better that not too much importance is given to macro noises, because wealth is created by investing in right set of businesses and holding it for an extended period of time. So in that context, I think investors should continue with a well-defined asset allocation and invest in a disciplined way for the longer term. Yeah.
Neelesh Surana, what a pleasure to speak to you, and I hope that you'll indulge us again very, very soon.
Thank you.
Thank you so much for joining us.
Thanks.
On Fund Anatomy. With that, we'll wrap up this episode, but do stay tuned to CNBC TV18. There's a lot more coming up.